Intermediate Accounting, Chapter 7A, Appendix. Chapter 7A, Cash Control. After studying Appendix 7A, you should be able to 10. Explain common techniques for controlling cash. Cash control. Companies are moving away from using cash, but control issues are still relevant. 2 issues in accounting for cash transactions: proper internal controls, no unauthorized transactions by officers, employees, or others. Information is needed in order to properly manage cash is available. Using bank accounts. Using different bank accounts for different purposes. A general checking account used for day-to-day activities. Imprest bank accounts used for specific purposes such as payroll. Lockbox accounts used for collections in subsidiary locations. Arrangements made with a local bank to pick up and deposit funds received allows for quicker collection and availability of cash. Imprest petty cash system, 1 of 5. Designed for disbursements where payment by check is impractical. Control processes and procedures include the following: designate a petty cash custodian. Custodian prepares a summary of petty cash receipts and disbursements each time the fund requires reimbursement. Custodian is responsible for getting a receipt for each authorized disbursement. Check to replenish petty cash is prepared and transactions recorded by someone other than custodian. Imprest petty cash system, 2 of 5. Cash over and short account used when the cash in the fund plus dollar amount of receipts does not equal the balance of the petty cash fund. Additional control procedures include unscheduled fund counts to ensure fund balance is maintained. Receipts are marked after being submitted for reimbursement in some way to ensure they cannot be used again. Imprest petty cash system, example 3 of 5. A petty cash fund is established for $300. A check is issued for cash with the following entry made: debit petty cash fund $300, credit cash or bank $300 to set up a petty cash fund. No entries are required when petty cash disbursements are made. Imprest petty cash system, example 4 of 5. When the fund is low enough to warrant a check being issued, or at the end of an accounting period, the receipts are summarized. The following disbursements are made. For example, office supplies 42, postage 53, entertainment 76 for a total of 171. The custodian counts the cash and finds there's 127 cash. The fund is $2 short. 300 minus 171 equals 129. Once the custodian has ensured all receipts and cash have been accounted for, the $2 difference is considered cash over and short. Imprest petty cash system, example 5 of 5. A check is written for the required amount of 173. So 171 plus 2. The entry to record the check is debit office supplies expense 42, debit postage expense 53, debit entertainment expense 76, debit cash over and short 2, and then credit cash or bank for the credit of 173. If the fund was to be reduced to 250, then you would debit cash for 50 and credit petty cash fund for 50. So that brings it down from 300 to 250. Bank reconciliation, 1 of 3. Ensures there are no errors. Ensures no omissions have occurred during the month. Ensures unusual transactions are properly recorded. Should not be completed by the same person who writes checks or prepares or makes the deposits. Bank reconciliation, reconciling items, 2 of 3. 1. Deposits in transit. Deposits that have been recorded in the books of account but not yet by the bank. 2. Outstanding checks. Checks that have been recorded in the books of account but have not yet cleared the bank. 3. Bank charges. Service and other charges made by the bank but not yet recorded in the books of account. 4. Bank credits. Collections or deposits made by the bank but not yet recorded in the books of account. 5. Bank or depositor errors. Any unrecorded errors by either the bank or the company. Bank reconciliation. Form and content, 3 of 3. You start with your balance per bank statement end of period. You add deposits in transit, any undeposited receipts or cash on hand, bank errors that understate the bank statement balance. Then you deduct outstanding checks and bank errors that overstate the bank statement balance to get your correct cash balance. Then you have your balance per company's books, end of period. So you have your book amount, then you add your bank credits and collections not yet recorded in the books, your book errors that understate the book balance, deduct your bank charges not yet recorded in the books, and book errors that overstate the book balance, and then that gives you your correct cash balance. And the balances should equal each other.